Markets are losing steam on banking fears coming off of somewhat decent earnings across the board so far. Microsoft carrying the market today, surprising to the upside with some earnings, or not surprising, but coming in with earnings to the upside. Right now, market's up about 10 minutes to close. The Dow is down 0.79, S&P down 0.5%, NASDAQ was up a little over 1%, now back down, or back up about 0.37%. The big news is First Republic potentially is going to be the next bank to fail. The Fed is not going to rescue the bank. They said that we don't need to be involved, but the bank is looking for some rescuers wanting to sell their shares and bonds above market value for a bailout. So pretty interesting plan. First Republic said in its quarterly report Monday that it's reviewing strategic options to help reshape the balance sheet. The steep decline in its deposits is a group of 11 larger banks infusing $30 billion into First Republic. So advisors to First Republic are trying to convince at least a few of those banks to provide further support by buying some of First Republic's assets at above market rates. Those purchases would result in losses for the other banks, but First Republic's advisors are trying to tell the banks or sell the banks on the idea that letting First Republic fail would lead to would be even more expensive if it led to still higher regulatory costs and fees. So how do you like that? Pay us more than you should and lose less than you might lose if you let us fail. So we'll see how that works out. The Fed has said, and Treasury has said, we are not stepping in. FDIC will probably, obviously, if there is a bank failure, backstop the deposits, but investors are going to lose and the stock is tanking. So we'll jump in and take a look at that here in a second. But overall, that's basically what's going on, is that banking fears are overshadowing strong tech earnings. And, tech earnings were decent. I wouldn't call them strong, but, Microsoft climbed more than 7% to trade at its highest point in more than a year after beating Wall Street's expectations. But again, it's all just a game in terms of the guidance that they provided. And when you look at earnings year over year, not that great, but they're just beating guidance that they're providing previously. So let's take a look at the chart, see what's going on. I've been drawing a bunch of lines. I am not a technical analyst, full disclosure, but I like to study the charts and draw lines because I'm an opportunistic macro investor in everything I do. I look at the global macro environment, the national, regional, local macro environment, micro environments to kind of make my investment decisions. I like to buy low, sell high. That's what opportunistic is. I'm looking for opportunities in price dislocations, distressed situations, things like that, to be able to get, below market value deals, whether it's real estate, whether it's a company, a business, or whether it's securities or other investments. You want to have some margin. You make your money when you buy. So you want to make sure that you're buying at a discount, buying below market, taking advantage of inefficiencies and or opportunities. So that's opportunistic investing. So I kind of work, with the charts, kind of watching different trends and things. And what I've marked out is April for the last 2 years, obviously April 2023 and April of 2022. This is the Dow. And you can see we've consistently been putting in lower highs and we've got higher lows. So this would be a pennant fault pattern in a declining market. So generally a pattern like this will most likely break to the downside, especially if it breaches the lower level of this and doesn't put in another higher low or a lower higher low. Lower higher low than this one previously, right back in this area here, the initial sell-off. That's your last higher low, kind of finding support on that level right now. So if it breaks this last higher low from the first initial drop of the market, then it could potentially come down, test this line here, maybe get a bounce, pop back up to here, and then go down and ultimately test this trend line that I've connected from the March 2020 lows, a more broad support level. If that breaks, then we could continue down and retest these October lows. A lot of analysts are saying that we most likely will retest the October lows, especially with the Fed hiking again, with some concerns over banks and the potential for a recession. So if you get banks failing, a recession happening, and the Fed hiking, that's kind of the perfect storm, the trifecta, if you will, that could lead markets down to retest those October lows. And we've got the same pattern kind of going on in all the markets. The NASDAQ, same thing. This is your declining, falling market pennant right here that could potentially, if this line breaks, the lower line of support breaks, then you could look for a bounce down to this, more macro support line that was put in, off of these lows from, again, 2020, March of 2020, and then most recently in January this year. And again, April is marked off for this year and last year, kind of in the same boat. And S&P doing the same thing, putting in the same pattern. So our markets are still putting in lower highs. They are putting in higher lows, or lower higher lows in regards to the overall macro trend. This one's still not near the first higher low that we put in, or lower high that we put in right here on the initial lower low that we put in on the initial sell-off in markets. NASDAQ has not popped up to that first low that was put in as the market's been declining. So if the market was going up and putting this pattern in, then you can look for this to be a continuation to the upside, a rising pennant pattern, but we're in a declining market, so it's a falling pennant. So the likelihood of this breaking to the downside is pretty good, unless things just suddenly change. The Fed comes out, doesn't hike rates. Here's the VIX bouncing off that 16 level, continuing its ascent, finding resistance at the 19 level. If the VIX pops up to that 30 level, the last time we saw that was in March. The 30 level was March 13th. Back in that time frame, let's just take a look at the S&P, and that's your March area right there, where it put in a higher low when the VIX spiked up. And you go back to October. Let's see what the VIX was in October. That September, October, the VIX was up in the 34, 35 level. 40 levels obviously would be a deeper pullback. So all eyes are on the VIX to see if we get a volatility event and a spike in the VIX. Dixie's still kind of hanging out. I have two schools of thought. Stanley Druckenmiller came out and said he is short the dollar, and it's the biggest position that he's ever taken in his career. But he said that's coming off the back of the biggest miss of his career when the dollar rose from over the last year, 2 years. He did not do anything with the dollar, and really coming off of, let's put it on the weekly so we can look at the dollar here. Really coming off of, I guess, basically right in this area here, 2021. So the low on the dollar was January of 2021. He missed this entire parabolic move in the dollar. So he does not want to get left behind this time. So he is short on the dollar, calling for the dollar to retreat back to that 90 level, with what's going on with, countries around the world trying to get off of the dollar and the whole de-dollarization. 2 years in retreat. The 10-year catching a little bounce, been kind of ranging here as investors are hiding out for the safety play. Let's see, oil is running at $74 a barrel, continuing to work its way back down, maybe to test that low potentially in the 60s. We'll see what happens, and we'll see what OPEC does about that, because they want oil above $80 a barrel. Closer to 90 is what OPEC would like to see. Right now, oil is retreating, and we're coming into the months of most demand for oil, summer months with people traveling. Big news of the day, Bitcoin retreating completely from this big bounce. A lot of people were calling for new all-time highs, bull market, and really what's going on here. So this whole move here in Bitcoin is basically a manipulated move by market makers, by exchanges, by whales, just general manipulation of price, investment funds, hedge funds, large capital, because it's low volume, price is cheap, so it's easy to move. And the narrative of the banks failing that would bring everybody into Bitcoin all of a sudden in crypto. So they're just kind of taking advantage of that narrative. Price spiked on the First Republic news, but it rejected right at that trend line. So trend lines are interesting. Sometimes the price respects them, sometimes it doesn't. But it's held, it held that recent rally in Bitcoin. It found resistance right at that trend line level, working its way down for the day right now. So we'll see what happens. Of course, there's also short, long liquidations as well. A lot of people were going short here, looking for that 25 level that I still believe we're going to come down and test next, especially from here. So they get liquidated, then that creates a cascade, and then everybody's going to, a lot of people are going long here, looking for that ultimate breakout, because everybody's talking about bank failures, and Bitcoin is the flight to safety. So then longs start getting liquidated and price just completely reverses. So big spiky day for Bitcoin today. Let's look at a cleaner Bitcoin chart here with no lines on it. You can kind of see it there, and let's look at it on the hourly. And you can see what's happening here on the hourly as price was consolidating down at that 27,000 level. Big spike up on the First Republic news, and now just completely big giant reversal candle here over the last hour, completely reversing that entire move almost back down to the 27 level and continuing down as we speak right now. So same thing, Ethereum, same thing, XRP, same thing, Cardano, same thing, Solana, Matic, DOT, Avalanche, Litecoin. So when you look at that same exact price action across the board, you know exactly what's up. It's all manipulation by the market makers. That's how they make their money. They have to feed the buyers and sellers. The exchanges are trading against their clients, liquidating them. When you put your order out there on the books, the exchanges see it, the market makers see it, so they're going to liquidate you and take your positions and take out all your stops and create that liquidity. That's where they make their money. They make their money in the ranging markets. And same thing with the whales, same thing with other investment funds, just kind of sucking people into the narrative, buying low down here, selling high up here, buying low down here, selling high up here, and then just, kind of accumulating along the way, exiting up in these areas, accumulating. So right now, this is not a broad, when you see these moves, retail jumping in, everybody getting in, institutions getting in and all that. This is all manipulation right now by the market makers, the exchanges, and large investors because liquidity is low, price is cheap, so it's easy to move the markets quickly. So, and especially when you see the exact same price action in all the assets all across the board, you might get a spike with one or two here or there, but that's how you can kind of spot, just complete manipulation, which it is what it is. Markets are manipulated, traditional markets are manipulated, a lot of automated trading out there, a lot of trading bots, a lot of algorithmic formulas, if this, then that. If price reaches, certain levels, then it triggers buys, it triggers sells on Fibonacci's, on trend lines, things like that. So that's why technical analysis is important if you're short-term trading or shorter-term trading, swing trading, day trading, and high-frequency trading. Those levels are important. If you're a long-term holder and you have a long-term investment outlook, then it's really up to you. The key is to know the top. So you always want to get out when you can at the top so you can buy in lower. And you want to be able to sell when you want to sell for what you want to sell for versus selling when you have to sell for whatever you can get. So that's really the key, because you can get caught in these cycles. These cycles can last for years. We'll take a look at that on the next video in terms of, how long a bear market can really last. So if you have a long-term horizon, you get caught in the down of a bear market and you need to liquidate to, take care of whatever life expenses, it can be a problem. So you always want to be understanding where the top is so you can take some chips off the table and be ready for the downturn to get through it and take advantage of the opportunities that arise. So these are the things I'm looking at. I'll see you in the next video.